Let me be direct with you from the outset, because what happened in global markets in the past 48 hours is not random volatility. It is a coordinated response to intelligence that institutional investors have received indicating that the situation in the Strait of Hormuz has deteriorated beyond the point where diplomatic resolution is likely. Oil futures jumped 12% in a single trading session. Insurance rates for tanker transits have tripled. And most tellingly, sovereign wealth funds from the Gulf states have begun liquidating positions and moving to cash at a pace that suggests they are preparing for imminent conflict. I am looking at proprietary market data from energy trading desks that shows something extraordinary. Major oil companies are paying premiums of up to $15 per barrel above market prices to secure immediate delivery of crude to refineries in Europe and Asia. That is not normal market behavior. That is panic buying by companies that believe supply chains are about to be severely disrupted and want inventory positioned before the disruption occurs. The last time we saw this pattern was in the 72 hours before Iraq invaded Kuwait in 1990. In the next 20 minutes, I will walk you through exactly what triggered this market reaction, why professional investors with access to classified intelligence are positioning for conflict, why the window for diplomatic resolution has essentially closed, and what you personally need to do to protect yourself from the economic damage that is coming. This is not fear-mongering. This is documented market behavior by sophisticated actors who have information you do not. Let's start with what actually changed in the past week to shift market sentiment from cautious to panicked. There have been three specific developments that, when taken together, indicate an escalation spiral that neither side can now control. First, Iran announced that it is conducting what it calls comprehensive defensive exercises in and around the Strait of Hormuz for the next 30 days. These exercises involve the full spectrum of Iranian military capabilities: naval forces, including submarines and fast attack craft; air defense systems along the entire northern coast of the strait; anti-ship missile batteries; and most concerning, the deployment of what Iran describes as intelligent mine systems in shipping channels. The announcement came through official channels, but the intelligence that is moving markets came from classified briefings to energy companies and financial institutions. According to sources who attended those briefings, U.S. intelligence agencies have confirmed that Iran has pre-positioned mines in the strait, but has not yet activated them. The mines are equipped with remote activation systems that can be triggered by Iranian Naval Command. This means Iran can close the strait within minutes if it chooses to, and there is no way for the United States or any other power to prevent it without starting a shooting war. Second, the United States responded by announcing that it is deploying additional carrier strike groups to the region and conducting its own freedom of navigation exercises through the strait, regardless of Iranian warnings. This is the classic pattern of escalation through competitive signaling. Iran says the strait is under its control. America says international waters are free for navigation. Both sides commit to positions that require them to demonstrate resolve. And both sides have domestic political constraints that make backing down nearly impossible. Third, and this is what triggered the immediate market reaction, Saudi Arabia quietly informed its largest customers that it cannot guarantee deliveries beyond the next 90 days. Not because of production problems, not because of technical issues, but because Saudi Aramco, the state oil company, cannot get insurance coverage for tankers transiting the Strait of Hormuz at prices that make exports economically viable. Insurance companies are either refusing coverage entirely or charging premiums so high that they add $30 to $40 per barrel to transportation costs. Subscribe if you are realizing that the global economy is balanced on a knife edge and the people who manage that economy are quietly preparing for the worst. Now let's talk about what the market reaction tells us about what professional investors believe is coming. Announcement number one: oil markets are pricing in a 70 to 80% probability of the strait being closed or severely restricted within the next 90 days. That probability is reflected in futures prices, options volatility, and the behavior of physical traders. Oil futures for delivery 3 months out are trading at a $20 premium to current spot prices. That is called backwardation, and it indicates that traders believe oil will be much harder to obtain in 3 months than it is today. Normal market conditions show a slight premium for near-term delivery because storage costs money. A $20 premium is not normal. It is a bet that supply will be disrupted and prices will spike. Options markets tell the same story. The cost of call options, which pay off if oil prices rise, has increased by 300% in the past 2 weeks. Institutional investors are buying protection against oil, hitting $150 to $200 per barrel. These are not retail speculators making small bets. These are hedge funds, sovereign wealth funds, and energy companies spending billions of dollars to hedge against catastrophic supply disruptions. According to data from the Intercontinental Exchange, the primary venue for oil futures trading, open interest in call options at the $150 strike price has increased by 400,000 contracts in 2 weeks. Each contract represents 1,000 barrels of oil. That is 400 million barrels of oil exposure that investors are betting will be worth at least $150 per barrel. The combined value of those positions is approximately $60 billion. Nobody deploys $60 billion based on speculation. They deploy it based on intelligence that tells them disruption is coming. The physical oil market is even more revealing. Tanker rates, which measure the cost of shipping oil by sea, have increased by 200% for routes that transit the Strait of Hormuz. But rates for routes that avoid the strait have only increased by 30%. The differential tells you that the market believes the risk is specific to Hormuz, not general transportation risk. Shipping companies are charging enormous premiums to transit a waterway where they believe there is a high probability of being attacked, detained, or caught in a war zone. Received. That is announcement number 1. Announcement number 2. Major oil companies are activating contingency plans that were designed for wartime conditions. This is not routine business continuity planning. This is preparation for sustained conflict that disrupts supply chains for months or years. Stay with me, because this is where market behavior crosses from pricing risk to actively preparing for catastrophe. According to reporting by Bloomberg, based on interviews with energy company executives, several major oil companies have initiated plans to reroute shipments away from the Persian Gulf entirely. This involves switching suppliers, renegotiating contracts, and accepting higher costs for oil that does not have to transit Hormuz. Some companies are increasing strategic reserves by purchasing oil now for delivery to storage facilities in consuming countries. Others are hedging currency risk because they expect that oil supply shocks will cause major currency volatility. But the most telling indicator is what Saudi Arabia and the UAE are doing. Both countries have built pipelines that can transport oil from their eastern fields to Red Sea ports without going through the Strait of Hormuz. Those pipelines have historically operated well below capacity because Hormuz transits were cheaper. In the past month, both pipelines have been operating at maximum capacity. Saudi Arabia is moving 5 million barrels per day through the East-West pipeline. The UAE is moving 1.5 million barrels per day through the Abu Dhabi crude oil pipeline. Combined, that is 6.5 million barrels per day that are being deliberately routed away from Hormuz, even though it costs more. Think carefully about what this means. Saudi Arabia and the UAE have better intelligence about regional security than any Western country. They have direct communication with Iranian officials. They understand the risks better than anyone, and they are acting as if Hormuz is going to be closed. They are not waiting to see what happens. They are repositioning their export infrastructure now, before the crisis hits, because they know that once it hits, there will be chaos and no ability to adapt. According to leaked diplomatic cables, US officials have asked both countries to publicly assure markets that oil supplies are secure. Both countries have refused. Their position is that they will continue selling oil to any customer who can arrange transportation and insurance, but they will not guarantee deliveries or prices. That is effectively washing their hands of responsibility for the crisis that is coming. Received. That is announcement number 2. Announcement number 3, and this is the part that personally affects you regardless of whether you follow geopolitics. The economic damage from a Hormuz closure will be immediate, severe, and global, and there is nothing governments can do to prevent it. 17 million barrels of oil transit the Strait of Hormuz every day. That represents approximately 20% of global oil consumption and 40% of seaborne oil trade. There is no combination of strategic reserves, alternative suppliers, or conservation measures that can replace that volume quickly enough to prevent massive price spikes. The United States Strategic Petroleum Reserve contains approximately 400 million barrels. That sounds like a lot, but global consumption is 100 million barrels per day. If Hormuz closes and 17 million barrels per day disappear from the market, the Strategic Petroleum Reserve could replace that lost supply for approximately 23 days. After that, prices spike and shortages begin. According to analysis from the International Energy Agency, a sustained closure of Hormuz would cause oil prices to exceed $200 per barrel within 2 weeks and could reach $300 per barrel within 2 months if the closure persists. At those prices, gasoline in the United States would cost $10 to $15 per gallon. Heating oil would become unaffordable for many families. Diesel prices would make freight transportation prohibitively expensive, which would cause food and consumer goods prices to spike. The economic ripple effects would be catastrophic. Every $1 increase in oil prices reduces global GDP by approximately 0.1%. If oil goes from $80 per barrel to $200, that is a 14% reduction in global economic output. That is not a recession. That is a depression. Unemployment would spike, stock markets would crash, governments would face budget crises as tax revenues collapse and safety net spending explodes, and there is nothing policymakers can do to prevent this. The Federal Reserve cannot print oil. Fiscal stimulus cannot create oil. Diplomatic initiatives cannot open the strait if Iran has decided to close it and is willing to accept the consequences. The only solution is either a negotiated resolution that prevents closure or a military operation that removes Iranian ability to close the strait. Neither option is currently on the table. Now let's address what mainstream media will not, which is that this crisis is the direct result of failed American policy choices over multiple administrations, and the people who made those choices are not the people who will suffer the consequences. The decision to withdraw from the Iran nuclear deal created the conditions for this crisis. The decision to impose maximum pressure sanctions without a viable pathway to negotiated resolution guaranteed escalation. The decision to maintain large military forces in the region while lacking the political will to actually use them created the perception of American weakness that emboldened Iran. Every one of these decisions was made by policymakers who will not pay the price when gasoline hits $10 per gallon. They will not lose their jobs when businesses close because transportation costs make operations unprofitable. They will not choose between heating and eating when energy bills triple. The costs of their failures will be borne by ordinary people who had no say in the decisions and no ability to prevent the outcomes. According to economic analysis from the Peterson Institute for International Economics, a sustained oil shock of the magnitude that Hormuz closure would cause would push approximately 50 million people globally below the poverty line. Real people, real families, real suffering, all because political leaders on multiple sides chose confrontation over compromise and escalation over de-escalation. This pattern is not new. The oil shocks of the 1970s were caused by political decisions in the Middle East that American policymakers failed to anticipate or prevent. The economic damage lasted for years. Inflation destroyed savings. Unemployment destroyed careers. And the people responsible for the policy failures faced no consequences while ordinary citizens paid the price. So where does this leave us? 3 scenarios, and the markets are currently betting that the worst one is most likely. Path 1, diplomatic breakthrough in the next 2 weeks that provides Iran with sanctions relief in exchange for guarantees not to interfere with shipping. This would require both sides to make major concessions and accept deals that their hardliners will oppose. Probability based on market pricing is approximately 20%. Path 2, limited conflict where Iran harasses shipping and the US conducts strikes against Iranian coastal defenses, but neither side pushes to full-scale war. Oil supplies are disrupted, but not completely cut off. Prices spike to $100 to $150 per barrel, but do not reach catastrophic levels. This is the muddle-through scenario. Probability approximately 30%. Path 3, full closure of Hormuz, followed by sustained conflict. Iran mines the strait, attacks tankers, and dares the United States to either accept the closure or start a war. Markets collapse. Oil hits $200+ per barrel. Global recession begins within months. This is what $60 billion in options positions are betting on. Probability 50%. The fact that professional investors with access to classified intelligence are assigning 50% probability to the catastrophic scenario should terrify you. These are not pessimists or conspiracy theorists. These are people whose job is to accurately price risk, and they are pricing in a coin flip between managed crisis and economic catastrophe. Here are the questions you need to ask yourself. First, how exposed are you personally to energy price spikes, and what can you do now to reduce that exposure? Second, do you have emergency savings that could sustain you through a period of job loss or business failure caused by economic crisis? Third, do you trust that political leaders understand the severity of what is coming and will make the decisions necessary to prevent it? Tell me in the comments what you are doing to prepare for potential economic disruption. Tell me whether you think diplomatic resolution is still possible or whether we are watching an inevitable march toward conflict. We are monitoring markets in real time and will update you as conditions change. Subscribe now. Share this analysis with anyone who needs to understand that what happens in a narrow waterway in the Middle East is going to directly affect their household budget, their job security, and their financial security in the coming months. Turn on notifications because when the market moves, you will want to know immediately what it signals about what is coming next. We will see you in the next update.